Good afternoon and good evening. I'm Keesa Schreane and welcome to the Refinitiv Perspectives live stream. Oil prices sunk to their lowest levels in history yesterday, dropping into negative pricing as oil supplies overwhelmed the globe's storage capacity. This is an unprecedented event brought on by the global impact of coronavirus. Joining me today is Jim Mitchell, head of Americas Oil Analysts at Refinitiv, to explore what this means for the markets and for the industry. Jim, thank you for joining us. Jim, thanks for joining us there. I can see you, but I can't hear you. Thank you for joining us.
Oh, thank you. Thank you for having me.
Great. So first, perfectly. We can hear you now, Jim. First of all, could you let us know exactly what led up to such a dramatic point?
Great question. The fact that the market has been leaned on from probably the last 6 or 8 weeks due to this COVID-19 got us into the ballpark where something like yesterday could have even happened. What happened yesterday was a function of the financial market, the financial aspect of the market relative to the physical aspect of the market. So what happened yesterday was there was either a customer who was holding too many futures. Yesterday was the second day to expiration. Today, in about a couple of hours, the May contract will expire. There's limits on how many contracts you can hold up to 3 days, and then each of the 3 days. If it were the case that somebody had too many contracts, they would have been sold, and they would have hit the market as a market order, blindly just being sold. So when that happens, when you're in a market that's particularly fragile like we are now, you get an event like we had yesterday.
Okay. So you mentioned, we know there is the financial side of the market and then there is the physical side of the market. How long can we expect both of these to trade in the negative territory? And also, what factors are at play for those?
Yeah, good question. So I want to be clear that I've been in this market 20 some years, and I have not seen crude oil trade negative in the United States ever. Yesterday, what happened was it was a financial event that happened. The physical market never traded negative, not even close. How long could we see the negative happen? It's possible for the futures today, the May contract could go negative again. It's very possible that it could happen in June, when June expires, somewhere around the 18th, 19th, 20th of June. Possible, not very probable. On the physical side, it's possible for physical oil to trade negative. It's pretty unlikely.
Okay, so possible, but pretty unlikely. Well, let's take a broader perspective and look at what's going on globally. We've heard about the agreement between Saudi Arabia and Russia with some intervention from the U.S. Now, is this agreement going to help stabilize prices in the coming months? What role does the agreement play?
Yeah, great question. Of the three that you mentioned, these are the three largest producers of crude oil in the world: Saudi Arabia, Russia, and the United States. Two of those three governments have the ability to limit oil production within their country, Saudi Arabia and Russia. The U.S. certainly does. They haven't done that since, I think, 1972. The president has the ability to do that. He's going to be very, very reluctant to do that because there's a whole bunch of consequences if he does do that.
Well, take us through why is there that reluctance and what sort of consequences?
So the reluctance mostly revolves around litigation, and whose incentive is it to really cut oil in the U.S.? There's a pretty big dichotomy between the big oil players, and I'm talking about the big international oil companies, and the smaller producers. There's somewhere in the neighborhood of 80 producers in just the Eagle Ford part, which is Central Texas. I'm guessing 65 of those nobody's heard of if you're not in this market. They have much different economics of production, of distribution than the larger companies do. In there lies the problem for the president, and not only for the president, but the state regulators in Texas. Oil production is regulated by the Texas Railroad Commission. 3 commissioners run that. They just voted within the hour to not make any cuts mandatory in Texas, and they referenced they were concerned about the possible litigation.
So basically, right now, we all see what's going on, including the states. And right now, they're holding firm, if you will. No changes are being made on the back of that.
That is from Texas. Some of the other bigger states, North Dakota is going through that now. North Dakota produces a little over 1 million barrels a day. They're looking at the same kind of thing, and I'm sure they're concerned about the same kind of thing. Louisiana, they're looking at the exact same thing, literally as we speak now. And I suspect that they're going to be interested about the litigation and the possible litigation. I know that the general counsel for each of these regulators is in these meetings, as referenced by the news that has been put out by Reuters in the last hour.
Okay, great. So if we see these shifts and swings, I know many folks on this live stream are saying, I hear what you're saying, but I'm not seeing a difference at the pumps. When will what we're seeing now with the markets impact consumers in terms of oil prices and gas prices?
Yeah, great question. There's a lot of infrastructure that, unless you're in the industry, you would never even think about. In between, when gasoline, for example, comes out of the refinery and gets to the pump in your neighborhood, there's pipelines to consider, there's oil tanks to consider, there's transportation to consider, there's people, there's a whole bunch of insurance, there's a whole bunch of permits. None of those costs are being decreased. So I wish, I'm a driver as well, I wish the pump price would decrease. I don't see it decreasing a whole lot more from where it is, though.
Okay. So moving from consumers to our institutional investors, if I'm an institutional investor, what concerns should I have right now? Specifically, if I do have some of the major oil players in my portfolio, what should I be thinking about? Should I be making changes? Should I be reading between some lines? What should be top of mind for me for an institutional investor?
Well, I certainly don't want to advise an investment bank on what to do. Some things that I would be looking at is I would be looking at their ability to cover debt. I'd be looking at their ability to minimize some of the activity that is not making the same margin that some of the other activities are.
Okay, great. So we're going to be opening up to questions from the audience shortly. So get those questions ready to my live stream audience. But meantime, what is the outlook for oil prices in the U.S. in the coming months? Jim?
Great question. That is certainly $1 million question. There's 4 things that I've been following to kind of give me an indication of what's going on in the market. One of them is from our partner Fathom Consulting on our system, Icon, and it has to do with enplanements. Enplanement is literally a passenger getting on an airplane and the airplane taking off. All of this data is aggregated by the FAA, Federal Aviation Administration, and then distributed. 3 events really have my attention. One is the quantity of enplanements after 9/11. That's September of 2001. That was obviously an airplane-related event. The shock to the system was significant, not unlike what we're experiencing now. It took about 1.5 years to get back to the same level of enplanements that we were in, say, August of 2001. Shortly after that, the Iraq War started. That was a different kind of demand destruction. That took about 1 year to get back to the same employment levels as we were when the Iraq War started. The third, and by far the biggest one, was the financial meltdown in 2008. That took about 7.5 years to get back to the same employment level. Now, that was a different kind of demand destruction. I suspect what we're going to see here is some combination of those three. So employments is one. Two, follow the prices, the day prices, and we have them on our system, the day prices of the very large ships that move oil around the world. And I'm talking about VLCCs and Suezmax ships. These prices are sky high right now because there are a lot of market participants using these vessels as storage, and they've booked them for some a month, some a year. So it's going to vary. Keeping on top of VLCC prices and Suezmax prices, day prices, will be very interesting. Third is storage levels. With one of our customers, Genscape, we can see the various levels of storage around the Americas, so Canada and all of the US, the major storage facilities, on a near real-time perspective. Staying on top of that is going to give you a really good idea for what the producers are going to face. Can they actually produce and sell their oil? The fourth and final one is the refiner cracks. What a refiner crack is, it's the price of the crude oil going into their system and the against the prices of the commodities, gasoline and diesel and jet being three of them, that leave their facility. So that crack, when it gets negative, does not stay negative for long. Refiners have a much better ability to shut down their plant than oil producers, for example, have an ability to shut down their production. So when the refiner margin is positive, it's giving the incentive for refiners to produce more gasoline and diesel. It's a little bit of an aberration now because these cracks are positive, mostly because the crude price is so low. So it's given a bit of a false signal. If refiners scale up in a big way in the next month, the problem that we have with storage in crude oil will be transferred to a problem of storage in gasoline and diesel.
Well, thanks for those 4 excellent pieces of insight, Jim. Very detailed. I'm going to go to our live stream audience now for a few questions. First question is, will U.S. oil go to zero physically? So what does that look like?
It's possible, not very probable. If one looks at our system and on the interactive map, you can see the ships that are moving around the world, and it's a significant number. So is it possible? Sure it is. Is it probable? Probably not.
So thank you for that. Another question, what is the role that Mexico really contributes in the world situation as it relates to oil and gas? Where does Mexico play a part?
Yeah, great question. Mexico has been a very good partner for the U.S. on the supply and the demand side. So let me try with the supply side first. The primary grade that's produced out of Mexico has limited ability to go everywhere in the world. It fits really, really nice in with the refineries in Houston and Corpus Christi. And a lot of Mexican oil, their main grade is called Maya. Maya fits really, really nice in with the Texas refineries. It does not fit as well with the Louisiana refineries. So Mexico continues to and will continue to supply crude oil to the world. It's not just the U.S., but the U.S. is a very good partner for that oil. On the counter side, Mexico has a significant amount of refined product demand that they can't meet with their refineries, which means then that the U.S. supplies a lot of gasoline and diesel and some other stuff like LPG and natural gas to Mexico. And that partnership has been very strong now for a couple of years.
Great. Very informative, particularly the type of oil that is produced and provided in Mexico. Thank you for that. How will the first signs of fuel demand be manifested in data?
Repeat the question, please.
Sure. How will the first signs of fuel demand be manifested in the data? So how will we begin to see that in the data that we're looking at, that we're viewing, that really helps to inform our decisions?
Yeah, great question. On our system, we have rack prices and volumes. So what a rack is, it's literally a stack of pipes that go up about 12 or 15 feet and that feed tanker trucks. So that the tanker trucks that we see on the road that supply gas stations, where the gas station for the gas station is called a rack, and they are everywhere in the country. We have prices and volumes at I can't tell you, a lot of places around the country. Keeping track of the rack prices, this is grassroots demand. This is where the demand will originate. And it's places like Tuscaloosa, Alabama, Hearne, Texas. When you start to see these places, the price start to creep up and the volume sold start to creep up, that's a grassroots example of there's something positive going on there in that part of the state, in that economy.
Great. Thanks. Good insight on how to look at the data to understand what's coming in the future there. Our next question, will there be alternative uses for oil in the coming months in an attempt to ramp up demand? What do you think about that, Jim?
Oh, good question. So crude oil is used for more than just gasoline and diesel and jet. There's a whole lot of petrochemicals that come from crude oil. That demand specifically around polyethanes, which are plastic wrap, garbage bags, all that kind of stuff. That demand doesn't necessarily go away just because we're all sitting at our house. So that demand will be there. Are there alternatives to that? I think all the alternatives that are available have been explored. There's some very smart people that look at this kind of thing and what else can you do with products from crude oil. They've been explored pretty well.
Okay. So do you think lower prices will encourage some businesses to utilize more oil if they haven't before? Are there use cases for that?
That's a good question. A lot of that's going to be dwarfed by gasoline and diesel usage. So will gasoline and diesel usage increase with lower prices? Absolutely, no question about it. Will companies use more oil products because of the lower prices? Hard to say. I would suggest, though, that any of that is going to be dwarfed by gasoline and diesel usage.
Okay, great. So are the typical supply and demand factors, are they in play right now? Do you see anything different than the classic oversupply and demand factors shifting because it is oil? Or do you think as supply and demand goes, this is a classic case of it?
Yeah, I'm a trained economist, and so I'm all about supply and demand. I do think we're seeing classic supply demand fundamentals. We're getting to the point now where supply and demand, the financial incentive, is getting minimized, and it's about survival. And when it gets to that point, there are events that happen that don't seem to make economic sense. We're at that point now.
Great. So getting back into the audience questions here, another one, what drives the huge differential between Brent and WTI, and what drivers could result in shrinking of the difference?
That's a great question. That could be an entire webinar all on its own. There are different
shot at it.
there are different forces working on Brent than working on WTI. When those different forces get stronger one against the other, that's when you see the Brent TI spread expand or decline. I could literally talk for a day on that.
But if you could just give us a couple of lines on that, what is the very short, concise answer?
So, okay, let me give you an example. Sure. So when, if you're somebody who typically buys oil from Nigeria, for example, Nigerian oil, and there's a bunch of various grades, generally gets priced off of Brent. So if you want to hedge, you're going to go to the Brent market, not the WTI market, which means you're going to be, depending if you're on the buy or sell side, you're going to be interacting with the Brent prices and not the WTI prices. That's a substantial amount of oil that affects the Brent market that has nothing to do with WTI.
Great.
That's
okay,
just one
thanks for
example.
That. Okay, great. Sounds great. Next question. What impact will it have if WTI prices continue to hit new lows on the employment in U.S. and oil company profit margins? Will this be negative for the next few years?
It's unlikely that'll happen. I would be shocked if we see a negative physical oil price. There's just too many places to put oil. Now, is it impossible? No. Will we see it for years? No, I don't think so. I think if one looks at something like the employments that I talked about previous, you'll see that there is a recovery rate for what we're going through, for the demand destruction that we're going through. Will it last years? It's possible, but pretty unlikely.
Okay, great. Considering current yields required by investors, how can this affect this scenario in short and midterm capital investment? So I'm going to read that again because I put some words in here. What I think the writer is trying to say: considering current yields required by investors, how can this impact the scenario in the short term and in the midterm in terms of capital investment?
Yeah, great question. And I hear a lot of this in the Texas market and the people that operate facilities in the Texas market. The investment for building new infrastructure in Texas in the last maybe 9 months is almost disappeared to zero. There's just not yield for it. Now, I think really it comes down to, is there an alternative purpose or alternative place that investors can put their money as opposed to anything oil related? And that's questionable. And that's probably an answer more from my counterparts on the equity and bond side than an oil guy like me. But on the oil side, opportunities are slim, and they've been slim for a few years. The infrastructure in Texas and Louisiana and New Mexico and North Dakota and Oklahoma, it's pretty built out. So can they get yield? I'm not seeing it.
Okay. This next one goes back to something we talked about a bit earlier. Global storage on land and at sea is closing toward max capacity. Is there any thought currently to creating new storage or converting other storage to deal with the current demand?
Yeah. So it's difficult to do this. So, for example, to build an oil tank takes somewhere around 9 or 10 months. It's not something that you can just throw up. There's a lot of permitting to do, certainly in the U.S., but everywhere in the world, because this stuff can be very toxic. And I'm talking about crude oil, can be very toxic to the water supply. So there's a great care in when you build a storage tank. And also, this stuff's pretty heavy. If it's not built on a proper foundation, the foundation of that tank and some of that cement is feet thick. It cracks, and then you have a problem. So is there consideration? Absolutely. That's always talked about. That's one of the areas where there has been some ability to get yield. Temporarily, it's going to go wherever it can. So the easy thing now is ships. And we're seeing it, and we're seeing it in a big way. Hence my point about watching the ship prices, the day prices on our system. It will be very indicative as to, are more ships being leased to store oil or less? And as for alternative, I'm sure there are facilities in the process of being built. It's slowed down like most of the rest of the economy. But absolutely, there certainly are. In addition to that, and it could be related to that question, can the SPR, the Strategic Petroleum Reserve that the U.S. has, and the other major countries have as well, Japan, South Korea, India, they all have SPRs. Can oil be injected into there? Certainly it can. There's a certain moral hazard in doing that, though. And let me explain that. In the U.S., there's, I think, 4 sites, SPR sites now, and they are big, huge caverns in the ground. They're salt caverns where water was injected into the cavern. It created a brine. The brine was pumped out, and it created this big column, 600 to 1,000 feet tall and maybe 300 or 400 feet wide. So this big, huge column, thousands of feet under the ground. Oil's been injected into there for a number of years, since the 70s in the SPR. So the U.S. has about 78 million barrel capacity left to inject into the SPR. Is that possible? Sure. Here's the problem. Even though the Department of Energy separates the grade that goes in there, there's a moral hazard problem in that for anybody putting oil in, you have the incentive to put the lowest quality oil in because you're going to get the average quality out. And there's significant financial impact in doing that. So is it possible? Sure. Is it going to happen? Yeah, probably. Is it going to be some financial impact? Oh, definitely.
Thanks for that great explanation. Last question. Will the drop in the price of crude oil have any geopolitical impact on the U.S. global situation? We'd love to get, I'm all ears, Jim.
Wow. Again, I could
Great
talk
question, by
for
the way.
a week on that one. Yes, absolutely. Yeah. Oil has been a geopolitical pawn for 100 years, long time, and it will continue to be. It's probably more in focus now than it ever has been because of what's going on in the world, and it will continue to be for probably at least 10 years into the future. It just 10 years related to this event.
Yeah. Wow. Jim Mitchell, head of Americas Oil Analysts at Refinitiv. Jim, this has been a wonderful discussion, very informative, insightful. Thank you so much for joining us.
Oh, thanks for having me.
And we want to thank everyone for participating, all of our live stream partners. If you've enjoyed today's live stream, there is a webinar I'd like to recommend for you. You should register for it. It's entitled Global Oil Markets, A New Normal. Now, we will include this link in the chat, and you can also visit www.refinitiv.com/events to get more of the details on this and other webinars we have in store for you. And the really great thing is that it doesn't matter where you are in the world, you can access that. Also, we'll be back live on Friday to talk about FX trading and the happenings there. So be sure to follow Refinitiv and subscribe to the notifications. Thank you all so much for joining. Have a fantastic day and be well.